Hi, my name is Riaz Sidi, marketing partner with SAAS North, and today I'm joined by Laura Lenz at OMERS Ventures. Laura is a partner leading the fund's investment activity in Canada for the organization. She has over 15 years of venture investing experience, and we're really happy to be able to chat with her today all about SaaS and on the investment side. Thank you so much, Laura, for joining me today.
Absolutely. Happy to do this.
Excellent. So I read an article recently that you wrote about SaaS companies focusing on one key metric, and that metric is revenue per employee. Why is this metric so important, and what conclusions can SaaS companies draw from tracking against this metric?
Sure. So revenue per employee is a very important metric because the employee base in a SaaS company represents the majority of its OpEx. And so understanding how much revenue you can derive from each employee in your business is a really important metric to look at. You can look at the revenue per employee offset by the salary per employee to see how profitable the business is. And you can also look at how much contribution the employee is providing in either each functional area or a go-to-market strategy. Some of the more sophisticated companies could look at a specific go-to-market strategy that they have. For example, let's say they've just launched a partnership strategy. After a year, they can look at the revenue that was contributed from that partnership strategy divided by the number of employees that were allocated towards that partnership strategy to determine if they're getting the right ROI from the business and if they should continue to pursue that strategy.
Do you have kind of a baseline metric or a kind of some guidance based on the stage the company might be in as to what that target should be?
Sure. So KeyBank actually put out a report in 2019 that said that the median revenue per employee for companies that are generating more than 5 million in ARR is about 135,000. So I look to companies that are generating revenue per employee greater than that number, obviously, to show that they're in the top decile.
Mm-hmm. One of the metrics that I read in one of the articles that you wrote was around lifetime value being 3 times that of customer acquisition cost. What are some other rules of thumb that astute SaaS founders should be adopting?
Sure. So we can talk about some of the astute metrics specifically. I'd just like to say that often LTV to CAC can be a general number. And so you really need to understand what are the calculations that go into LTV and what are the calculations that go into CAC to ensure that it's a fully burdened CAC number, that you're putting in customer support and implementation as part of your CAC costs. Otherwise, it's not a true LTV to CAC number, and you can actually overinflate a number that's not the case. In terms of other metrics that best-in-class SaaS companies should be looking at, obviously we talk about the rule of 40, right? So revenue growth less your EBITDA profitability. Oftentimes you can't both grow quickly and be profitable, so we're willing to sacrifice a little bit of profitability if you're growing very quickly, right? Sure. So that's one metric that we would look at. The other metric is a net dollar retention metric. So you'd want to have net dollar retention greater than 125%. This is how much more revenue can you get from your existing customer base, and of course that decreases your CAC over time. Mm-hmm. And then churn is another number or another metric, that we would look at, where your annual churn you want to have less than 5%. And then the last one is a capital efficiency burn ratio. So how much capital are you spending? How much cash are you spending in a year to bring in additional new ARR? And that number, that ratio should be less than 1 times.
Over the last few months, COVID-19 has disrupted the economy. The investment world, I'm sure, has changed as well. I'm interested to learn about that. And specifically, how has the investment world changed as it relates to SaaS companies?
Sure. So the longer we're in a bull market, the further and further away we move from true financial metrics. And I might even say we move towards unrealistic and inappropriate metrics, right? You've seen companies that have looked at number of eyeballs, number of users on a platform. You've seen community adjusted EBITDA as a metric. These aren't true metrics that we should be looking at long term. And so what I think is important is velocity, profitability, and capital efficiency. And those can be measured in many different ways. But I think for right now in COVID, companies need to look at those three areas to determine whether or not they're well positioned for fundraising in this environment. And in this environment, VCs are looking for a longer cash runway. So they're looking for 18 to 24 months of cash runway. They're relying more and more heavily on investors that are already on the cap table. So you want to make sure as a founder that you have support from your existing investors, and they will provide great reference calls for you. And I think founders should expect a softening in valuations as VCs price in additional risk and additional uncertainty. I will say though, it's a tale of two cities out there. And so if you do have best in class metrics, then you will be able to raise capital at a strong EV to ARR multiple. And in OV's portfolio itself, we've had a couple of companies that are best in class metrics, and so they've been able to raise at that 12 to 15 times. That's not happening for everybody right now.
Right.
And some companies that don't have those best in class metrics are starting to see structures in their legal documents that we saw 10 years ago, right? So pay to play provisions, full ratchets on price protection, those kinds of structures that haven't been in place for quite a while.
Okay, so digitization of traditional businesses is also a massive trend over this period of COVID. What are some of the other trends you foresee occurring for SaaS companies as a result of the pandemic?
Yeah, I think there's a massive pressure for automation wherever there's a close proximity business. So that could be retail, that could be restaurants, that could be manufacturing, could be food processing plants. I think we're also seeing a massive acceleration in adoption of e-commerce. And so any solutions that are able to facilitate payments online and build trust online, we'll see good success coming out of COVID. And then I think the food delivery industry has accelerated very quickly. People want food in their homes. They don't want to necessarily go to the grocery store. So you're seeing a steepening of the adoption curve of online delivery and food, meal kits, things like that. I think you're also seeing a automation in the supply chain and a decrease in the number of nodes in the supply chain, as well as people look for efficiencies and automation there. And of course, there's everything other people are talking about: virtual care, online learning, distributed team collaboration, workflow solutions.
Laura, thank you so much for taking the time out of your day to join me and to chat about investments in the SaaS world. Where can our audience learn more about yourself and OMERS Ventures?
Sure. The best way to find me is probably on my Twitter handle @Laura Lenz. Thanks for having me.
Excellent. Thank you so much, and have a great day.